Hello everyone, welcome back to my channel where we always try to learn everything easily. So today we are going to talk about Variable Reverse Repo Rate, VRRR. So you must have heard of this VRRR term very recently, and you'll be hearing this in news also. RBI is conducting a 3-day VRR, a 7-day VRR. So for anyone who wants to learn banking terminologies or is aspiring to become a banker, needs to basically understand these small terms. But before we understand VRR, let's try to understand what is reverse repo. So if you want to understand repo rate, I have a video which I put earlier on the Monetary Policy Committee. So there I've explained what is repo rate. It is basically the rate at which the banks borrow money from RBI. Now reverse repo is the rate at which commercial banks park their excess liquidity with RBI at a particular rate. So when you park that excess amount with RBI gives you a particular interest rate for that. So it's like borrowing money to RBI. So you're giving a certain amount of money to RBI and RBI is giving you a particular interest rate for that. You're getting something in return out of it, right? It is basically, so VRR is basically a subtype of reverse repo rate. So I've put this extract here. This is from the Reserve Bank of India Act. If you go to that act, you will find this 45 where definition of reverse repo and what is given. You can have a look at that. So now we'll try to understand what is VRR. So VRR is basically a tool to suck the excess liquidity from the banking system. Now reverse repo is already there, right? Just like repo is there, reverse repo is there. You can park your money with RBI and get the reverse repo rate. But VRR is a variable reverse repo rate. So the rate is not fixed. The rate varies. How does the rate vary? The rate varies because RBI is going to conduct an auction. So in that particular auction, various banks will come and they're going to give their bids. So they're going to say that I'm going to give the excess liquidity to RBI if I get this interest rate. So accordingly, RBI will have an auction wherein different variable rates will be put, and then RBI is going to decide on which rate it is going to give out. Whatever is the lowest rate, of course, RBI is going to accept that rate and it's going to take that excess liquidity from the bank and keep it with it and give that rate of interest to the bank whenever necessary. So basically it is for a short period of time, either for 7, 14 or 28 days. The auction route is used. So the rate, as I said, in VRR, in reverse repo, there is no auction that is done. Whereas in variable reverse repo, there has to be an auction that is conducted so that the banks are ready to accept the lowest interest rate for the deposits with RBI. So when the banks are putting these deposits with RBI is going to select that bank, whoever bids the lowest rate, because RBI also wants to be at a profit, right? RBI also wants some margin to have when it comes to giving out the rates. So this is basically the minimum interest rate which is above the reverse repo rate. So of course reverse repo rate is there, but the VRR is generally above the reverse repo rate. Now why is this VRR basically done? This is done to suck out the excess liquidity from the economy. So whenever RBI thinks that the liquidity has increased in the economy, RBI will try to suck that out. Because what will happen if there is a lot of liquidity in the market? So let's assume there's a lot of liquidity in the market, then banks are going to become risk taking, right? Because they have a lot of money. So they are going to lend to people as much as they can so that they can earn something from the money and their risk taking capacity increases. So too much liquidity also is not good. To monitor that, to suck out that liquidity from the economy, RBI conducts VRR time to time. Now what will happen? Now if there's a lot of money in the economy, the asset prices will go up, right? Because a lot of money is circulating, prices will go up. More money, which basically means prices will go up, which basically will again mean that inflation is going to go up. So again, this is like a cycle, okay? To keep inflation in control, to keep the liquidity in control, to keep the money supply in control. These are certain tools that RBI uses, like repo, reverse repo, and VRR is one of those tools. But here it is a subset of reverse repo and it is a variable rate which is done through an auction. So lower interest rates. So what will happen if there's a lot of money with the banks? The banks are going to give out loans at a lower interest rate, right? As the rates will keep going down, RBI will not be able to further cut rates to stimulate economy. So there has to be a balance, right? You cannot just increase the amount of liquidity to a great level and let banks decrease the rates at a very high level. So to keep that balance going, these various tools are used by RBI time to time to keep everything in balance and in control. So this is what is VRR, and as I had said in the beginning, as we had seen, RBI was supposed to hold on 21st, on 15th July, RBI was supposed to hold a 3-day VRR. So basically, they're going to held a auction for the rate at which the commercial banks will park the excess liquidity. So I hope the VRR term is clear to you. In the next video, we'll try to pick up another term which is which is used in the banking terminologies, or which is used by RBI, and we'll try to decode it easily and make it easy for us to understand going forward. Thank you so much for watching the video. Please like the video if you enjoyed it, and see you next time. Bye.